Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I am Darshan Mehta. Let's welcome our experts then, JayKumar Toshniwal of Toshniwal Equity Securities and Vineeta Sharma of Narnolia Financial Advisors join us on the show. Thank you to both Jay and Vineeta for joining me on the show. Today on Hot Money, we'll discuss stocks like Britannia, we'll discuss the cement sector, we'll discuss of Tata Steel, and we'll discuss Page Industries. So that's what we have lined up for the show today. The first stock we want to talk about is Britannia. The counter trading above the 6,000 level over the past few days. Today it's managed to correct slightly, but nevertheless trading near record highs. It's been a mass outperformer. It's gained almost 65% in the 12 months itself. So the big question that we're asking our guest right now is that will the rally in Britannia continue, or valuations is something that they are concerned on? So Jay, you have a minute to opening statements. Do you think that the rally in Britannia will continue?
I think Britannia is trading at rich valuations. It has significantly increased in prices in the last 4 years, almost 12 times, and it reflects most of the improvements which the company has done. So though there is potential for it to go further, but on an immediate basis, I don't see any major significant rise in the price of the stock. Though I believe the stock will always continue to command rich valuations because it's a leader in its own field. And it has undertaken some major capex, and the results will be showing in the next 2 years. So I feel on an immediate basis Britannia could sort of top out here, but it's a stock to be accumulated because it's a big story on the foods, and it's amongst the biggest food companies comparable to Nestle, with a great growth potential, growing at about say 11-12% per annum.
Okay, so that's the view that's coming in from Jay. He believes that at this point of time it will pretty much top out, but growth potential is there and that has to be accumulated. Vineeta, your opening statement, do you agree with Jay? Do you believe that there is enough potential for Britannia? Will the rally continue, or are you feeling that valuations pretty much are topped out right now?
See, I very well agree with what Jay said, and basically we need to understand why Britannia has gone up in the last 5 years. The prices have doubled, and the basic reason why we see Britannia doing so well is because the EBITDA margin has expanded very well. It has gone up by 10 odd % it has gone up, and this is basically due to Varun Berry joining in FY 13-14 and then changing the strategy of distribution strategy. So now it's it has touching around 19.5 lakh retail outlets. This EBITDA margin has been increasing because of the basically because of selling and distribution cost coming down. So we don't find much lever in the EBITDA margin going up again, though how the premiumization would play out, how the Indian snacking industry would do later in that segment, I feel Britannia should do well.
Okay, so I think the consensus view is that there seems to be a little bit of issue as far as valuation is concerned, but overall both of our guests do believe that the traction in Britannia will continue. I'll start with you, Jay. In terms of Britannia, what are the key triggers going ahead? You say that at this point of time valuation is something that pretty much may have topped out, but going ahead you believe for the long term it's a stock that one should accumulate. What are the key triggers that will lead growth for Britannia? Because the financials haven't moved that much over the past. I think they're doing over the last 3 quarters they did some 2,500 crore top line. The profit is also in that range, so they haven't outperformed as such. What makes you so bullish on Britannia in the long term?
Basically, you have to understand what has happened in Britannia in the last 4-5 years. Since the entry of Mr. Varun Berry, who has a great experience in PepsiCo in the Indian snack food industry, what I find is that the company has put together a strategy whereby they have gone into premiumization of their products. They've got new launches, brand extensions, product categories, and for example, Good Day come with choco chips and oat cookies. So you have premium products, extension of the product lines. At the same time, distribution reach has been increased almost 2.5 times in the last 5 years, say from about 7.5 lakh outlets to about 19 lakh outlets, as she just said. At the same time, they have been innovative in their products and cutting down on cost. The supply chain efficiencies have started playing out. They have cut down on wastages, trade returns, and product rejects. So this way, cost efficiencies have been playing out very well. At the same time, to improve the product quality, they have come with new factories based on imported machines. large plants, all ISO certified. So this has helped them to push the product well. Rural business is something which is growing now. Rural market has almost doubled in the last 3 years for them. And I expect that with launch of almost 50 products in the next 4 to 6 quarters, the company would be able to sustain a sales growth of about 11-12%, which they've been doing now. They have commissioned about 8 factories in the last 1 year, and about 2 more coming in at Ranjangaon and Nepal this year. So with a capex of almost 1,000 crores in next 2 years, I think that sales growth of 11-12% could go up slightly to about 13-14%. Margins have been largely steady, which can improve a little bit, but not too much. Exports have been growing. They have been adding a country each year. Now they're already into 3 countries, and they expect exports to grow from 7% of sales to about 12% of sales. Okay. They have about 8 power brands, each having sales of over 500 crores, which can grow to over 1,000 crores in the next 4 years.
Okay, do you agree with that? I think you also spoke about premiumization, what they've done. In a scenario where it's becoming extremely competitive, new brands are coming in, foreign brands are coming in, and the local companies also are going in for premiumization. Do you think that run rate will continue for Britannia?
Yes, certainly, because overall, if you look at the Indian markets, and Indian people in general, people have developed a taste for, the premiumization is coming from within. It's not just on the urban sector now. So people are, very focused, and especially it's an edible product that Britannia gives you. So they are having, that quotient with them. Okay. Basically, like what you were discussing, I would like to emphasize on, like we have in our notion that the valuations are very high for Britannia. I feel that, already the Britannia's valuations, if you see, the kind of margin growth that Britannia has brought in last 5 years, from 3% net profit margin to 10% plus net profit margin. This kind of, valuation justifies, because now the EV upon sales for Britannia is around 7.5 to 8 times. And that is almost at par with Nestle or any other, FMCG product. So now I can say that Britannia is trading at close to its peers. So I would not say that Britannia is too costly as such. If you look at its own history, the way it has moved, yeah, but from now on, I would say that Britannia's history, obviously, now the fortune, I would say, would depend on how well they are, able to cater to the premiumization as well as the Indian snacking industry.
Okay, so that's the view that's coming in on Britannia. I think both of our guests have given a bullish view on Britannia. It's a stock that needs to be accumulated. On the views of, premiumization, what they're doing, and valuations, according to Vineeta, are justified at this point of time, given the growth trajectory that the company has. The next stock we want to move about is not a stock, it's a sector. Pretty much there seems to be a lot of trouble as far as this sector is concerned. The bigger companies in the sector, the ACC, the Ambujas, they are trading at near record lows. Ultratech is the only one that seems to be outperforming. But what's the view on the sector? Has the sector bottomed out? Should someone look at accumulating cement stock? That's something that we'll ask our guest. Vineeta, I'll start with you. Your opening statement on the cement sector, has it bottomed out, or do you feel more pain is there?
See, we have a neutral stance on cement sector as such. There are 4 things which normally you would see in a stock while you pick up a cement stock. That will be the sales, and which constitutes of obviously the volume and the realization, and then it would be the margins. Margins depends on the freight cost and the fuel cost, and both have been rising of late, and continuously they have been on a rising tone. So I would say that okay, cement, we need to track how the volume growth comes up, because the realization almost is at par. I mean, it is not in this quarter it has gone up, but overall I don't see any very big thing happening except for the volume growth going up. So we need to track a little more, because it has to justify more on the EBITDA front and come up from the cyclical lows.
Okay, Jay, what's your view on the cement sector? Do you think that it's bottomed out, or there's more pain now?
We feel that cement industry is in the process of bottoming out. Probably it is almost done. We should consider that the cement industry has faced headwinds in terms of rising costs, because the pet coke prices have gone up in the last 1 year. Then your coal prices also have gone up. At the same time, due to this demonetization and GST, there was a lot of disruption in the real estate sector, which accounts for almost half the demand. So almost negligible sales of the housing units has led to a fall in the cement prices also, almost between 5 to 10% across the geography of India. So you have a falling sales prices and rising cost, which is pushing the margins down. And as a result, you find most of the cement stocks trading at lows. So this is a typical situation of the industry where it goes through a cycle of about 4 years. So we are in the down cycle right now, and probably we see light at the end of the tunnel, which could be maybe say a year down the line.
Okay, so that's the view that's coming in. I think the consensus view that we're getting in on the cement sector is that, it's more of a wait and watch approach. Jay believes that, probably in some time the cycle will peak out. Vineeta is neutral on the entire sector. That's what our company is. Vineeta, I'll start with you. You all are neutral on the cement sector. Any stock that as a house that you all are bullish on in the cement space?
Cement stock, yeah, definitely. We like, say in case if you look at the valuation trajectory, Ambuja Cement has already come down to around say $120 EV upon ton. So Ambuja is one stock where people can start accumulating. As a research person, I preferably, I prefer Ultratech cement.
Okay.
That's because of, the kind of scalability that it is undergoing, the kind of, the scale efficiency, as well as, the EBITDA margin for Ultratech has always been higher than its peers. Right now, it is the margins have come down because obviously once the sector is into a downturn, the costs are affecting the company. So Ultratech couldn't have been, saved off. But the kind of premium it commands over the prices, the margins, the way it has come down, I would suggest people to have Ultratech in their portfolio.
So basically, what I'm getting is that you would rather stick to the large cap than the regional plays in the cement space. Anything among the regional plays or the smaller cement companies that you all find attractive?
Yeah, there are a couple of stocks, which are good. Say we like Dalmia Bharat Cement.
Okay.
But then, at this point, the valuations, if you see for cement sector, they have not come down.
Okay.
The prices have corrected. It's because of the earnings that we see has been, down. The sales have moved up, not translated to the bottom line. So what we see is, you have certain stocks, but when the valuations are still on the upside, you would rather, go for a safer bet, which I like Ultratech.
Yeah, that's a valid point. So she's saying that despite valuations have not come out, prices have come down. Anything that you like in the cement space that catches your eye overall? Maybe it can be a pan-India player, it can be a regional player, anything?
See, if you look at the cement sector as a whole, you should understand that there is a big change happening in the industry. Over the last 10 years and accelerating the last 5 years has been consolidation. You see there are large capacity Ultratech acquiring Jayprakash and probably Binani now, and also Century Textile cement plants. So you are having the fragmented industry consolidated into 6-7 major players, which will lead to better pricing discipline. That is a major development. Second thing which is happening in the industry is that we are coming out of GST and Demon problems, and our economy is growing from $2.5 trillion to about $3.5 trillion in the next 3-4 years, with a saving rate of about 27%. The annual saving pool is about $650 to $750 billion, so which amounts to almost $2.5 trillion in next 4 years. So that much of wealth has to be invested in various assets. With better lifestyles, we expect the demand for housing to grow significantly in next 3-4 years. With the PM pushing in for the affordable housing and infra push, the demand has to grow. Demand for cement normally grows about 1.2 times of the GDP, with GDP growing at about 7.3 upwards. So we expect cement to grow about 9 to 10% in the next 3 years. At the same time, we find that the industry demand supply situation is reaching a stage where the incremental capacity coming up and the incremental demand coming up will balance out with demand edging over supply. So in this situation, the industry situation will be turning for the better. And within the industry, the leaders are Ultratech and Ambuja, no doubt. But Heidelberg Cement is something very interesting.
Okay.
This is a company, Heidelberg, multinational company, which has to grow. And they are still just sort of stabilizing within India, and they have not yet looked at a big growth, which can happen.
Okay, so I think the view on the cement sector as of now, what both of our guests have indicated, it's more of a consolidation that will happen. Valuations have not yet come out, and the general trend is that stick with the large plays. the ACC and Ambuja. Jay also spoke about Heidelberg Cement, which is something that you should look at. We'll discuss that at a later stage, but Heidelberg is something that you should watch out. The next stock we want to talk about is Tata Steel. Now, the counter has been consolidating and correcting ever since the news came out that the investors of Thyssenkrupp have indicated the fact that there could be some deal changes. It was a 50-50 joint venture with the EBITDA of Thyssenkrupp going up per ton, EBITDA going up and the Tata Steel Europe EBITDA not doing that much. There seems to be some bit of investor concern. Will the deal change or a deal not happening lead to a derating of Tata Steel? That's what we're asking. Your opening statement, if this deal doesn't go through, if there's some changes in the deal, will Tata Steel derate?
Yeah. Now, Tata Steel paid a bomb for buying Chorus. That can be said on hindsight after the 2008 crash. And it has been very difficult for Tata Steel to sustain the debt, which has almost remained constant over the last 10 years. And this opportunity with Thyssen would sort of lead to consolidation on the industry in Europe and help Tata Steel Europe to deleverage the balance sheet, service the debt better. At the same time, give flexibility to Tata Steel India to grow organically as well as inorganically, with a lot of opportunities in the insolvency process, for example, Bhushan. So this deal should not fall through at all for Tata Steel. It is very important for Tata Steel to consummate the deal, probably based on the developments in the last 1 year where Tata Steel Europe margins are a little lower compared to Thyssen and some shareholder activism coming up. If some minor changes in the deal have to be done in, I think Tata Steel should work to ensure the deal goes through. It should not fall through.
Okay, so that's an interesting statement. Tata Steel needs to work on the deal because this deal is extremely important. Agree that if this doesn't go through, it will lead to derating for Tata Steel?
Yeah, definitely, Darshan. I would say that this deal is very important for Tata Steel. But otherwise, if I look at it, Tata Steel has not been on our radar for quite some time. We have an avoid rating on Tata Steel. Because the kind of contingencies and the kind of uncertainties that has been built around the European business, it's very difficult for me as an analyst or a research head, if I am, to forecast the balance sheet and the profit and loss account of Tata Steel. With conviction, I'm not able to do it because there are way too much of uncertainties. With Tata Steel deal going through, the Tata Steel will be able to, transfer 2.9 billion euros of its debt and some 18,000 workers to the joint venture. I think this deal is really very important.
Okay, so I think both of us do believe that it's very imperative that this deal goes through. Jay, I'll start with you. You were saying that it's very imperative that the management should ensure. Now, Elliot is indicating that, the ratio should be skewed from 50-50 to 80 in favor of Thyssen and 20 in favor of Tata Steel. What's your view? How do you make of the deal? How should one value this deal? And what's the way ahead? Because they're also buying in a lot of Indian assets, and that debt is something that needs to go off the book.
What I believe is that as far as size of the companies are concerned, Tata Steel Europe and Thyssen both coming together are almost in similar size, maybe for 55-45. The only thing is that Tata Steel Europe is focusing more on industrial markets, whereas Thyssen is more into OEMs and technology products. So Thyssen has been able to maintain the margins. Once they are together, there are a lot of synergies which they get. Now, the shareholder activism is basically placed because they want a better value for Thyssen, because they are shareholders of Thyssen and Thyssen is doing better. Probably 80-20 is not what I would look at. What I feel is that instead of 50-50 JV, it could be probably a 40-60 JV, which will give a better valuation, maybe a fair valuation for both the companies. That should be something which should be workable.
Okay. And if this deal doesn't go through, it will be problems for...
Yes.
How will this, if this deal doesn't go through and Tata is looking at acquiring assets in India and looking to focus, does that totally take the shine away from what they're doing in India and again concentrate on the problems in Europe?
Basically, Tata Steel has been besotted with problems in Europe because of low profitability and slow market growth. Industry is doing well, which is a good factor for some time, but Tata Steel India is now acquiring Bhushan Steel and some more steel assets, so it is stretching the balance sheet. So it's necessary to deleverage somewhere, otherwise the whole balance sheet comes at risk with so much of debt. And servicing of debt is also an issue in Tata Steel Europe. So therefore I feel that leaving this deal will be very difficult for Tata Steel.
Okay, Vineeta, you all don't track Tata Steel very, very closely, or is there anything in the steel sector that you all find attractive? Because Tata Steel is an avoid for you. Is it only on account of complex issues there that you all have, or it's like a sell rating that you all have on Tata Steel?
No, we don't have a sell rating, just that we are not tracking the stock very closely. We have been tracking, but we have maintained an avoid rating. It's basically, it bars me from, because as an analyst, you need to have clear estimates.
But so anything else in the steel industry that you said, what are you all pushing to your clients? What in the steel sector? What are you all recommending?
See, I would personally recommend Jindal Steel and Power, because Jindal Steel and Power, if you see from last 2 to 3 years, it had been into a rough patch. And with a lot of government dues getting pending on to Jindal Steel. But as of now, the balance sheet and the P&L for Jindal Steel looks quite much in control. In the metal space, if you look at it, the company has done a capacity addition. It has tripled its capacity, and most of the debts now, the cash flow, free cash flow out of the capacity generation will start coming in the next 2 to 3 years. The debt equity ratio, which is around 2:1, where I see going down up in the next 2 years, it should come down to 1:1. As well as the free cash flow, I'm expecting around 15,000 crore of free cash flow in the next 2 years.
Okay, so that's the view that's coming in on the steel sector. Tata Steel, it's a clear indication. Everyone's on the wait and watch mode to what happens with the deal. 40-60 joint venture, as per Jay, would be probably decent by nothing. And if the deal doesn't go through, it's real trouble for Tata Steel. That's what even Vineeta said. But JSPL is the other stock in the steel sector that Vineeta also likes. And the final stock we want to talk about is Page Industries. Again, the stock managing to move up significantly over the past few days. Yesterday, the news coming in terms of extending the contract with Jockey to 2040, but the valuations again at multi-year high. So the big question we're asking is that will growth continue to overshadow valuations as far as Page Industries is concerned? Your opening statement, do you think valuations are a concern, or would you play the growth story in Page Industries?
Yeah, Page Industries, I would say, it's been a stock everybody has been ever wanted to get into. And still we have the view that every decline should be, getting into Page Industries. The valuations definitely, Darshan, it has gone, if you factor in 2 years of forward earnings of Page Industries, it is running around 7.5 to 8 times EV upon sales. I'm personally projecting, on EV upon sales, because sales growth is one thing which getting assured for Page Industries. So if you look at valuation, it is 7.5, 8 times EV upon sales. That's a little demanding, but look at the way the management strategy is playing out. Now the management is confident for 2040. That you can extend up to your portfolio bet. Okay, so it's a portfolio bet. What about you? What's your view on Page Industries?
Page has definitely run up on valuations. It's a premium product, a premium company, brand leader and market leader. So it always comes on premium valuations. It has a very strong interest from FI investors. So it's a stock which is sort of a buy stock for the FIs all the time. And I also believe, I agree with Vineeta, that it's a stock to be accumulated whenever there's a decline. This is one company which has been showing improvements in terms of profitability, in terms of growth, very rich returns on capital employed, over 50%. And now with the increasing focus on exclusive brand outlets, where they expect that the sales through the exclusive outlet should grow from 15% to about 40%. So that would lead to a better engagement of customers. They're also adding, going from innerwear to outerwear for children and leisure wear. So that will also add something to that. A recent development about Speedo, the Speedo swimwear, which is a global brand, has just come in. And I believe Speedo is growing very fast.
On that thing, I'll get back to you on Speedo, but I think the general consensus we're getting is that Page should be accumulated on every decline. Vineeta, I'll start with you. What about growth? Can Page continue to grow at such a pace on the base that is getting larger? Or is that a concern that you have?
See, Page right now has a top line of around 2,500 crores. And this top line has come, multifold. Year after year, you are seeing 30% odd growth. For the last 2 years, the sales growth has tapered also to 20 and a half. And last quarter results were also very, very encouraging. Top line going up by 20%, bottom line going up by 40%. Look at the structural story that is, running behind Page Industry. So I feel, there's still room for Page Industries to cater into the market segment. It is having a market share of around 20% in its segment. So with the GST implementation, the tax structures are almost the same. But what has happened for the, for the less branded people or for the unorganized players, now it is difficult, they have to raise their prices. And that is where, Page is standing at a very good command, because it gives the Page, much more lever to increase the prices. So volume growth setting in as per the structural stories that going on. Price realization room still there. If look at the industry in general, it is now, I would say, extending the outsourcing thing. From 20%, management has given a guidance for outsourcing to 40%. And that obviously would, keep the sales going. Asset is very light, 2.8 times asset turnover. I mean, something like, I personally see a lot of growth in Page Industries.
Okay, so it's a buy on decline and there is potential growth. You were talking about the Speedo and the strategy there. You can just continue.
Basically, Speedo Swimwear is a development with the company in the last few years, and it's growing at about 150%. And this is one area where we expect significant growth to come in. Jockey, innerwear, outerwear, and Speedo. These are the engines for the company to move forward. At the same time, distribution network being extended will be another engine for growth. And as Vineeta said, post-demo and post-GST, the organized sector is able to effectively counter competition from the unorganized sector. So that is a third point which will push the company's growth. What we also believe is that our country has grown from about $400 per capita to about $2,000 per capita now over the last 22 years. And history says that many countries, once they have crossed $2,000 per capita, they really take off. So we are in a situation where aspirational buying by people going to better brands is something which will drive this company forward.
Okay, so that's the view that's coming in on Page Industries. Both of our guests are pretty much convinced about the growth strategy for Page Industries. Yesterday we had the management and that they themselves were pretty confident of the growth path going ahead. But with that, it's a wrap on today's Hot Money. Vineeta, thank you so much for coming here. Jay, thank you so much for coming to the studio. Ask BQ comes up next. Stay tuned to Bloomberg Quint.